What is personal finance? Personal finance refers to the management of an individual's or family's financial activities, including budgeting, saving, investing, and planning for retirement. It encompasses a wide range of financial decisions and activities, from daily spending to long-term financial planning. The goal of personal finance is to ensure financial stability and growth by making informed choices about spending, saving, and investing money. The importance of personal finance. Understanding personal finance is crucial for several reasons. Money management. Effective personal finance helps individuals manage their money wisely, ensuring they can cover their needs and wants without falling into debt. Informed decisions. Knowledge of personal finance enables people to make informed financial decisions, such as choosing the right investments or understanding the implications of taking a loan. Debt avoidance, understanding interest rates, loan terms, and repayment strategies can help individuals avoid or manage debt effectively. Future planning. Personal finance allows for effective planning for the future, including retirement, education expenses, and emergency funds, ensuring long-term financial security. Historical context of personal finance. The concept of personal finance is not new. Historical records show that people have been managing their finances for centuries. For instance, in ancient Rome, citizens used a system of ledgers to keep track of their finances. The Industrial Revolution in the 19th century brought about significant changes in the way people managed money, with the introduction of banks, credit, and new forms of investment. Creating a budget. The budget is a financial plan that outlines expected income and expenses over a specific period, typically a month. It helps track where your money is going and ensures you don't overspend, enabling better financial management and planning. Steps to create a budget. List your income. Include all sources of income, such as salary, freelance work, and passive income. List your expenses. Categorize your expenses into fixed and variable. Subtract expenses from income. Ensure your expenses do not exceed your income. Adjust as needed. If expenses are higher than income, look for areas to cut back. Example of a monthly budget plan. Income. Total income is $2,500. Fixed expenses. Rent is $800. Utilities are $100. Internet is $50. Variable expenses. Groceries are $300. Entertainment is $150. Transportation is $100. Savings goal. Aim to save $200 monthly. Creating and sticking to a budget can provide several benefits, including financial awareness, control over spending, and the ability to make adjustments as needed to meet financial goals. Saving money. Saving money provides financial security and allows you to handle emergencies, make large purchases, and invest for the future. Different types of savings accounts. Regular savings account offers easy access but lower interest rates. High yield savings account provides higher interest rates but may have restrictions. Certificate of deposit offers a fixed term and interest rate but less liquidity. Setting up an emergency fund. Aim to save 3 minutes 6 months worth of living expenses in an easily accessible account. This fund can be used for unexpected expenses like medical emergencies, car repairs, or job loss. Understanding financial terms. To manage your finances effectively, it's essential to understand common financial terms. Interest rate, the percentage charged on a loan or earned on savings. Credit score, a numerical expression of your creditworthiness. Assets, resources with economic value owned by an individual. Liabilities, financial obligations or debts. Example of reading a bank statement. Account balance, total amount of money in the account. Deposits, money added to the account. Withdrawals, money taken out of the account. Fees, charges by the bank for various services. Investment basics. Investing involves putting your money into financial assets or ventures with the expectation of generating a return or profit over time. Common investments include stocks, bonds, and real estate. Why invest? Investing helps grow your wealth, achieve financial goals, and protect against inflation. It can provide additional income and help build a secure financial future. Types of investments. Stocks, shares of ownership in a company. They offer potential for high returns that come with high risk. Bonds, loans made to corporations or governments that pay interest over time. They are less risky than stocks but offer lower returns. Mutual funds, investment funds that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Exchange traded funds, similar to mutual funds but traded on stock exchanges like individual stocks. Real estate, investing in property for rental income or price appreciation. Understanding risk and return. Risk, the possibility of losing some or all of the money you invest. Return, the profit or income generated by an investment. It can come from capital gains, dividends, or interest payments. Risk-return trade-off. Generally, higher risk investments have the potential for higher returns, while lower risk investments offer more stable but lower returns. Retirement planning. Retirement planning is the process of determining retirement income goals and the actions and decisions necessary to achieve those goals. It involves identifying sources of income, estimating expenses, and implementing a savings and investment strategy. Types of retirement accounts. 401, an employer-sponsored retirement savings plan that allows employees to contribute a portion of their salary pre-tax. Individual retirement account, a personal retirement account that provides tax advantages for retirement savings. Roth IRA, a type of IRA where contributions are made with after-tax dollars and qualified withdrawals are tax-free. How much to save for retirement. Retirement age, when you plan to retire. Life expectancy, how long you expect to live post-retirement. Lifestyle, the standard of living you want to maintain. Healthcare costs, expected medical expenses in retirement. Example of calculating retirement needs. Lisa, age 35, plans to retire at 65 and expects to live until 85. Annual income needed $50,000. Retirement duration 20 years. Total savings needed $50,000 equals $1 million. Understanding insurance and risk management. Insurance is a financial product that provides protection against potential future losses or damages. In exchange for regular payments, the insurance company agrees to pay for certain expenses or losses. Types of insurance. Health insurance covers medical expenses such as doctor visits, hospital stays, and prescription medications. Life insurance provides a financial payout to beneficiaries upon the policyholder's death. Property insurance covers damage or loss to property, such as a house or personal belongings. Auto insurance covers damages and liability in case of car accidents. Disability insurance provides income in the event that a policyholder is unable to work due to a disability. Long-term care insurance covers the cost of long-term care services, such as nursing homes or in-home care. Risk management strategies. Identifying risks. Recognize potential risks that could affect your financial stability, such as job loss, medical emergencies, or property damage. Mitigating risks. Take steps to reduce the likelihood or impact of risks, such as maintaining a healthy lifestyle, installing home security systems, or having an emergency fund. Transferring risks. Use insurance to transfer the financial burden of certain risks to an insurance company. Tax basics. Taxes are mandatory financial charges imposed by the government on individuals and businesses to fund public services and infrastructure. They are essential for funding public goods and services such as education, healthcare, defense, and infrastructure. They also help redistribute wealth and stabilize the economy. Types of taxes. Income tax, tax on earned income such as wages, salaries, and investments. Sales tax, tax on purchased goods and services. Property tax, tax on property ownership, usually based on the property's value. Payroll tax, tax withheld from employees' wages to fund Social Security and Medicare. Understanding income tax. How income tax works. Income tax is calculated based on your taxable income, which is your total income minus any deductions and exemptions. Tax brackets and rates. Income tax rates vary based on your income level. Higher income levels are taxed at higher rates, which is known as a progressive tax system. Deductions and credits. Deductions are expenses that can be subtracted from a total income to reduce taxable income. Credits are amounts that reduce your tax liability directly. Example of calculating income tax. John has a taxable income of $50,000. Tax bracket 22%. Calculation. First $40,125 taxed at 12% equals $4,815. Remaining $9,875 taxed at 22% equals $2,172.50. Total tax $4,815 plus $2,172.50 equals $6,987.50. Filing taxes. Steps to file your taxes. Gather documents, collect W-2 seconds, 1,099 seconds, receipts for deductions, etc. Choose a filing method, paper filing, tax software, or hiring a professional. Complete tax forms, fill out the appropriate tax forms. Submit your return, file your tax return by the deadline. Important tax forms. W-2 reports wages and taxes withheld. 1099 reports income from self-employment, interest, dividends, and more. 1040 main form for filing individual income tax returns. Example of filling out the 1040 form. Jane earned $45,000 in wages and had $1,000 in interest income. Income section report $45,000 in wages and $1,000 in interest. Deduction section enter the standard deduction amount. Tax calculation. Use tax tables to determine tax liability. Conclusion. Understanding personal finance is vital for managing money effectively, avoiding debt, and planning for a secure financial future. By creating a budget, saving money, understanding financial terms, investing wisely, planning for retirement, managing insurance and risks, and understanding taxes, individuals can achieve financial stability and growth. Whether you are just starting your financial journey or looking to improve your financial habits, these fundamental principles of personal finance can guide you toward making informed and beneficial financial decisions.